Hello, my name is Evan, and welcome to Economics 101, your number one source for everything economics. Today, I want to make a quick video to talk about the Fed's move to leave policy rates unchanged. Before I get into the video, please like, share, and subscribe. Okay, here we go. And so basically what happened today, the Fed decided not to raise, not to cut, but to keep rates unchanged. They lowered their forecast on GDP, said they were going to be higher unemployment. PCE inflation was higher, core inflation was higher as far as their forecast was concerned. And these are, for the most part, are not good results. They're saying that basically we're facing stagflation. In my previous videos, you can see I talked about stagflation, and I'm going to talk about stagflation a little bit more and exactly what that is. But to recap, stagflation is low GDP or economic growth, high unemployment, and high inflation. And the problem with stagflation is the worst case scenario. Stagflation is the worst case scenario because you cannot fight stagflation with monetary policy. So if I have low GDP, if I got low economic growth, typically I can kickstart that with lowering my interest rates. If I lower my interest rates while I have high inflation already, lowering interest rates is only going to increase my inflation. So with stagflation, basically you're stuck where you're not able to fight against or help move either GDP, boost GDP by lowering our interest rates, or tame inflation. In order to get inflation down, we need to raise interest rates. And to be honest with right now, we need to be raising interest rates. The Fed, I think, has taken a standpoint on making it seem like they're fighting inflation, but we can see that inflation continues to go up and will continue to go up. There are too many things affecting the way that our monetary policy has been directed toward inflation. Rates need to go up, something needs to burst, but if we're given forecasts that are saying that GDP is low, expected to be lower, unemployment is expected to be higher, the way we combat that would be lowering interest rates. But if we already have PCE inflation higher, core inflation higher as a forecast, we can't lower interest rates because that's just going to get it higher. But what I'm telling you is the Fed has already made its decision. It's picked its side. Which fight are we going to fight? Are we going to fight inflation, or are we going to fight economic growth? And I think the Fed is going to always choose to fight economic growth. So what does that mean? Inflation is going to get higher, but inflation only negatively affects individuals like myself and pretty much 95% of the world. You have to understand inflation, again, increase the money supply. As a result, you get an increase in prices, but you get an increase in assets. But the majority of people don't own assets where inflation will help them. The average person typically sees inflation hurt them when they're spending at the grocery store, when they're buying stuff for their homes. They see their home costs go up, things like that. So costs are going to gradually go up. And like I said, you'll see asset prices, stock market, real estate, things like that continue to go up because inflation helps those things. It hurts the average everyday person though. So I really wanted to kind of break down that move by the Fed to keep rates unchanged, tell you exactly what that means for you. We're expecting, I project or predict that we're only going to see one more rate cut this year. However, they're predicting that you're going to see 2 rate cuts. I don't think you get a rate cut on May 7th, but I do think you possibly going to get your first rate. You're going to get the first rate cut in September. So we're going to keep our eye on that, and we'll just check and see, and I'll keep you updated. Please stay tuned for future videos. And again, please like, share, and subscribe. And thank you for tuning in.